In this video, we will walk through exactly what to do if your Danish annual report is delayed and you are approaching the deadline where fines and compulsory dissolution become a real risk, so that you can stabilise the situation, reduce penalties, and rebuild control. Let's start with where you stand legally. In Denmark, most companies must file their annual report with the Danish Business Authority, the Erhvervsstyrelsen, no later than 5 months after the end of the financial year, or 6 months for certain larger or listed entities. If you exceed that deadline, late filing fines are issued to the company and, in stages, to management. And if the report is still not filed, the company ultimately faces forced dissolution through the Danish Business Authority and the probate court. If you are watching this close to or shortly after your deadline, your priority is not perfection. It is to get a compliant, reliable report on file fast enough to avoid escalation. The first step is to clarify your exact status. Log into Work or check your company's mailbox to confirm the statutory deadline for your entity, whether any fines have already been imposed, and whether a notice of intention to dissolve the company has been issued. Note the dates carefully. There is a defined escalation timeline, and even a few days can make a decisive difference if you act quickly and proactively. Once you know your formal position, the next move is to assemble a small, empowered task team. At a minimum, this should include your finance lead or bookkeeper, your external accountant or audit firm if you have one, and a responsible member of management who can make rapid decisions. Make it explicit to everyone that the objective is compliant and sufficient, not perfect and delayed. In many delayed cases, the real blockers are missing documentation, unresolved accounting questions, or slow response loops between internal staff and external advisors. For the next few days, those bottlenecks must be removed. If your bookkeeping is materially behind, focus first on the core ledgers, bank accounts, debtor and creditor ledgers, payroll and VAT. Bring bank reconciliations fully up to date and ensure that all material cash movements are posted correctly. This will give your accountant the backbone they need to build the financial statements, even if a few minor items remain to be cleaned up later. In parallel, identify any complex or judgment-heavy areas that might slow you down. Asset impairments, revenue recognition on long-term contracts, provisions, or intercompany balances. Rather than allowing these questions to stall the entire process, agree on pragmatic, well-documented treatments that are consistent with Danish GRP or IFRS as relevant, and that your auditor can accept. Remember that lack of documentation is often a bigger problem than the actual accounting judgment. If you cannot obtain ideal evidence in time, write clear internal memos explaining management's reasoning and the basis for estimates. This can provide your auditor with enough comfort to move forward swiftly. If your company is subject to statutory audit, engage with your auditors immediately and transparently. Share your revised timetable and be honest about where you stand. Ask them directly what they need in the next 48 to 72 hours to be able to sign on time. Offer daily check-ins, shared document trackers, and prioritized lists of open points so they can focus on issues that are critical to their opinion, rather than being distracted by lower impact details. If your company is exempt from audit, the process can be faster, but you should still involve your external accountant or advisor to ensure that the report is technically correct, since resubmissions after rejection by the Danish Business Authority will cost valuable time and can increase your risk of sanctions. When you are very close to the deadline or already in the penalty window, communication with authorities becomes strategically important. If you have a credible plan and can demonstrate substantial progress, such as draft financial statements prepared, outstanding questions clearly listed, and auditor engagement documented, consider contacting the Danish Business Authority or discussing with your advisor whether it is useful to clarify your status. While the law is strict, showing good faith effort and rapid progress can sometimes help avoid the worst outcomes, especially when minor technical issues are the only remaining blockers. At the same time, you should prepare management for the financial and personal consequences that may still apply. Late filing fines are normally incremental, and directors can be personally fined in addition to the company. If a dissolution process has been initiated, there is a limited period in which you can reverse it by submitting the missing report and paying any outstanding fees. Make sure the board and key shareholders are fully informed. Delaying these conversations rarely makes the outcome better and can create governance issues if directors later claim they were not aware of the risk. As you push the annual report across the line, pay attention to quality control, even under time pressure. Perform a high-level analytical review of the draft numbers. Compare revenue, margins, and key cost lines with prior years and with your internal management accounts. Large, unexplained variances will trigger questions from auditors, tax authorities, or other stakeholders and could lead to further delays. Check that notes and disclosures are complete and internally consistent, including equity movements, related party transactions, and subsequent events. Finally, validate that the electronic filing format required by the Danish Business Authority is correct. Many last-minute submissions fail not because of the content of the report, but because the technical upload is incorrect or incomplete. Once the report has been successfully filed and, where needed, audited, turn your attention from crisis response to structural prevention. Conduct a brief internal post-mortem with finance, management, and your external advisors to understand what actually caused the delay. Was it under-resourced finance functions, weak processes, late delivery of source data from subsidiaries or partners, or insufficient planning with your auditor? Use that insight to redesign your year-end timetable with clear responsibilities, interim deadlines, and escalation mechanisms if milestones slip. In practice, leading companies treat year-end like a short, time-bound project with a clear owner, daily status during critical weeks, and proactive communication with all stakeholders. That might mean investing in better bookkeeping systems, training staff on Danish reporting requirements, or renegotiating expectations and timelines with your auditor well ahead of the next closing. To summarise, if your Danish annual report is delayed and fines are looming, your immediate focus should be to clarify your legal position, mobilise a focused team, catch up the core accounting records, align quickly with your auditor or accountant, communicate transparently with authorities where appropriate, and drive a disciplined but pragmatic process to get a compliant report filed as fast as possible. Once the immediate risk is contained, take the time to fix the underlying process issues so that next year's reporting is timely, predictable, and far less stressful for everyone involved.